Well, let's continue, decoding the budget fine print, what it's going to mean for the markets, and get your investment ideas as well. Joining us now to talk about that big event and what to watch out for next is Mahesh Nandurkar from Jefferies. Jefferies, incidentally, recently ranked #1 among foreign brokers in the recently concluded Asia Money poll. Good morning, Mahesh. This is Nayantara. So tell us, after the union budget and the way we saw the stock market also react, what's the call that you folks at Jefferies have for the Indian equity markets? Are you going to re-rate it? What's the advice that you're giving your clients?
Good morning, Nayantara, and thanks for your best wishes. Uh, so the budget, has definitely come in at a juncture where the global backdrop is, very, very tough. We are looking at the Fed tightening. We are looking at, in the Indian context, India's own current account, deficit rising to an 80-year high, and there's clearly a need for fiscal consolidation. So, the government and the finance minister, had all these things to keep in mind, before presenting, the budget. And I think in the current circumstances, I think they've done an excellent job. Because it's very difficult to put forward an expansionary budget in this point in time. So the government has done the right move by going in for the fiscal consolidation, which basically means that the overall expenditure growth is going to be muted. That was our expectations. So yes, I mean the overall expenditure growth is just 5%. If you exclude the interest cost, then it goes down to 2%. But that's what was really needed at this point in time. But within those limited or within those constraints of just 2% total expenditure growth, I think the government has made it very clear as to where they want to put their money. They clearly want to support the CAPEX growth, which is something that is badly needed for the economy as we await the revival of the investment cycle. So I think in those limited constraints, the government did an excellent job. The cues from the bond market, however, have been on the negative side. We've already seen the bond yields going up by 15 basis points yesterday and 40 basis points year to date. And if this trend continues, that cannot be a good news for equity markets for sure, because ultimately, the risk-free rates are going up, and that cannot be a good news for equity markets in general, especially in the context of what we have been seeing globally. But I think on a relative basis, clearly there is a thrust towards capex, and there is a push for investment cycle recovery. The finance minister said multiple times that the government's intention is to get the public investments to crowd in private investments. So I think that's definitely the way to go in my view. So what we are recommending is that one should be overweighting the domestic cyclical sectors. So we like banks here quite a lot. We like autos, as well. From a medium to long-term perspective, even some of the capital goods stocks, also, would be sort of, good. Although, I must highlight that the overall capex growth, if you adjust for, some of the things that we need to look at in the budget, is low. It's much lower at about 12 to 15%. But as I said, in the context of a 2% overall expenditure growth, even a 12 to 15% growth in the overall capex is a very welcome step.
Mahesh, hi, morning. And keeping in mind, the high crude oil prices, the inflationary pressures, as well as the US Fed signaling that there will be multiple rate hikes, what is it that you're expecting the Reserve Bank to do in the upcoming policy? Do you think that there will be some calibrated rate hikes as well on the anvil, and that will continue to push yields higher?
Yeah, I do expect that there would be, rate hikes, by the RBI. I mean, we've seen, many other emerging markets and the Asian markets have done the same. So India cannot really be living in an isolated island. And clearly, sort of, given where, clearly the bond market is telling you that, that the rate hike, is imminent. Maybe RBI has the option of deferring it by a couple of months, but I don't think we have an option but to raise rates.
Mahesh, what is the turning point at which you would say, look, today we are talking about industrials and cyclicals, but the multiplier impact of that will also be visible in rural facing businesses. It will also come back into categories in consumer names which have been which have exhibited anemic growth because of a slowdown there. Because if government is building and spending, the multiplier will automatically start coming back in the rural economy and the compressed parts of the economy, or compressed consumer behavior.
That's right, Nikunj. So, the government is trying to spend on infrastructure, and there is simultaneously a boom that we are seeing in the property and the housing market as well, which is also a large guzzler, if I can use that word, for rural labor. So all those things, point towards an eventual recovery from the rural consumer, from the rural demand side as well. But that recovery might be 6 months down the line, because all these things take time to reflect. And the initial spurt in job creation on the rural side may actually go towards building some of the initial reserves than immediately translate into demand right away. That's point number one. And point number two is, from the stock market perspective, many of these stocks are still trading at a very, very high P multiple. And in the, with the lack of CAPEX cycle recovery, there wasn't really visible growth in some other segments of the market. But, if what you're saying and what we just discussing turns out to be the case, that the CAPEX spending picks up, corporate CAPEX picks up, etc., infra, spending happens, and so on. Then from the foreign equity market investors, there'll be many other, options which were ignored for, quite a period of time, will begin to look more attractive. So I don't think that the expensive consumer names, which are currently seeing the pinch of weak rural demand, will really outshine in a big way, even if the rural consumption comes back, because then the equity investors will have many other options which will offer better growth prospects at lower P multiples.
Mahesh, how do you see things settling in terms of the average premium for India? And let me be slightly more descriptive this question for the benefit of our viewers. The favorite anti-India equity thesis is that Indian markets are trading at a premium to historic averages, and the gap between India and China is very high, so the risk-reward ratio is favorable for China. But can we say that the premium in India will sustain because of earnings, corporate governance, a stable tax regime?
Yeah, I think the single biggest driver for Indian premiums to sustain or stay at an elevated level is the strong support that we are seeing from the domestic equity investors. I mean, we are seeing close to about maybe somewhere between 25 to maybe even $30 billion annually coming into the equity market from the domestic, retail equity investors. I think that is going to be, the most important and the strongest, support, and which I, believe has the capability to keep the Indian multiples at an elevated level. Yes, there will be some times where investors will try to play that valuation arbitrage between India and China, and maybe in the near term that looks like a possibility, especially because while the rest of the world, including the developed world and India, etc., will be tightening, China's policies will be loosening, and that might attract some of the global investors to that market. But clearly, I believe that India is a much better structural story. So while those valuation arbitrage type of flows will happen in favor of China as compared to India, maybe in the near term. But and the structural story in case of India and these equity flows coming in from the domestic investors is the strongest part of India's story, I would say.
Right, Mahesh, great to have you on the show. Thank you so much for taking the time out.
Many thanks.